Hey everyone, you may have seen our branding update in our templates. It's part of the continuous improvement that we are making. I hope this new design works for you. Anyway, for today, buckle up, because today we're diving into something that's been making waves in the investment world, healthcare S-REITs. You know how some investments feel like a roller coaster, up one day and down the next? Well, these healthcare real estate trusts are more like a steady train ride. Reliable, resilient, and chugging along no matter what's happening out there. Curious why they're stealing the show in 2025? Stick with me, because we're about to unpack why healthcare S-REITs are here to stay and how they could be a game changer for your portfolio. Hey friends, welcome back to the channel. I'm Iggy, and I've been covering topics like stocks, finance, CPF, and everything related to growing your wealth. The Investing Iguana is ranked 8th in the 2024 Influential Tigers by Tiger Brokers, with over 768,000 reads and 53,000 likes. I've produced over 700 videos with more than 300,000 watch hours as of December 2024. I also focus on regional and world economy topics. So if you're into building wealth the smart way, you're in the right place. Now let's get into it. Imagine you're investing in something that doesn't freak out when interest rates spike or inflation kicks in. That's what healthcare S-REITs have been doing lately. As of February 20th, 2025, these trusts are the rock stars of the REIT world, posting an average total return of 2.8% so far this year. Not too shabby, right? And get this, they delivered 6.9% in 2024 and 7.1% in 2023. While other investments were sweating it out, healthcare S-REITs just kept on shining. Why? Because healthcare is one of those things we can't live without. Whether the economy's booming or busting, people still need hospitals and nursing homes. So what's driving this? Analysts are pointing to some big trends in Southeast Asia. Picture this. As countries get richer, think GDP per capita going up, folks start spending more on private healthcare. Add in an aging population and a boom in medical tourism, and you've got a recipe for growth. I mean, who wouldn't want top-notch healthcare as they get older or fly somewhere for a checkup if it's world class? This is why healthcare S-REITs in Singapore are holding strong, even with higher interest rates hanging around longer than an uninvited guest. Let's zoom in on the two big players here, Parkway Life REIT and First REIT. These are the heavy hitters listed on the Singapore Exchange, and they're showing us exactly why healthcare assets are so defensive. Parkway Life. REIT is like the king of the hill. It's one of Asia's biggest healthcare REITs, with 75 properties across Singapore, Malaysia, Japan, and even France. We're talking a portfolio worth $246 billion as of December 31st, 2024. Ever heard of Mount Elizabeth Hospital or Gleneagles Hospital? Yep, those are in their lineup. First REIT, on the other hand, has 32 properties worth $1.12 billion spread across Indonesia, Singapore, and Japan. Think nursing homes and hospitals keeping things steady. Now here's where it gets interesting. Parkway Life. REIT's been killing it for 5 straight years, 2020 to 2024, with a total return of 35.6%. That's the best performing S-REIT over that stretch. In 2025 so far, it's up 4.2%. First REIT's no slouch either, with a 1.4% return this year, making it the third best S-REIT as of February 20. But what's the secret sauce? It's all about long leases. These REITs lock in tenants like hospitals for years, sometimes decades. That means steady cash flow, no matter what's happening with the yen or interest rates. It's like renting your house to a tenant who pays on time every month. Pure gold for investors. Let's break down Parkway Life REIT a bit more. In 2024, they pulled in $145.3 million in revenue. Not bad, though it dipped 1.5% because of a weaker yen. Still, their distribution per unit, basically the payout to investors, grew 1% to 0.1490 taus. That's 17 years in a row of growth. They've also been smart about expanding, snagging 11 nursing homes in France to diversify into Europe. It's like planting new trees in your investment garden while keeping the old ones strong. Meanwhile, First REIT's rental income dropped 5.9% to $102.2 million in 2024, again thanks to a weaker yen and rupiah. But here's the kicker. Their portfolio's still rock solid, with 100% occupancy and sustainable leases. That's like having a fully booked hotel every single night. Hey, quick question for you. Have you ever thought about how global events shake up investments? With stuff like a second Trump presidency stirring uncertainty, experts are saying defensive assets like healthcare rights are where it's at. What do you think? Ready to ride this trend? Drop a comment below and let's chat about it. Let's talk real-world examples to make this stick. Take Parkway Life REIT's Gleneagles Hospital in Singapore. It's a top-tier facility, always busy, and locked into a long lease. That's cash flowing in year after year. Or look at S-REITs nursing homes in Japan, 14 of them. Japan's got one of the oldest populations out there, so demand's only going up. Back in 2021, S-REIT jumped into Japan with 12 nursing homes, and now that chunk's over 22% of their portfolio. Smart move, right? It's like buying a small shop in a growing neighborhood and watching it turn into a hotspot. Here's a simple analogy. Investing in healthcare S-REITs is like owning an umbrella shop in a rainy city. People need umbrellas no matter the weather, just like they need healthcare no matter the economy. And with long leases, it's like signing a contract to sell umbrellas every day for the next 10 years. Steady profits, low stress. Compare that to, say, a tech stock that's bouncing around like a kangaroo on a trampoline. Which would you rather bet on for peace of mind? Now, you might be wondering, aren't there risks? Sure, currency swings, like the yen and rupiah dropping, hit their numbers a bit. Parkway Life. REIT's revenue took a dip because of that, and S-REIT felt it too. But here's the thing. Their fundamentals are strong. Full occupancy, long leases, and growing demand mean they're built to weather those storms. Plus, they're diversifying. Parkway's move into France and S-REIT's Japan push show they're not putting all their eggs in one basket. Still worried? Think of it this way. Even if a storm's brewing, these REITs have a sturdy roof overhead. So what's the takeaway here? Healthcare S-REITs are showing us they're not just a flash in the pan. They're here to stay. Parkway Life, REIT's 17 years of payout growth and S-REIT's perfect occupancy are proof of that. If you're looking for something stable to add to your portfolio, these could be your ticket. Start by checking out their latest reports. Parkway Life REITs at C2PU and S-REITs at AW9U on the Singapore Exchange. Look at their assets, their leases, and how they're expanding. Then ask yourself, does this fit my goals? If you're new to REITs, maybe dip your toes in with a small investment and watch how it grows. Before I wrap up, here's a little nudge. Hit that like button if you found this useful, and subscribe if you haven't already. I'm dropping videos every week to help you grow your wealth, and I'd love to have you along for the ride. Oh, and if you're hungry for more, check out my video on why REITs are perfect for beginners. It's a great follow-up to this one. See you in the next one, friends. Iggy out.